Whatever you're thinking about buying a home or maybe refinancing, there's always that one big question, isn't there? What are mortgage rates doing?
Always. It's top of mind for so many people.
Exactly. And lately, well, it feels like rates are just kind of stuck, hovering just under that 7% mark, maybe.
Yeah.
Feels like forever.
Yeah, there's definitely that feeling of being in limbo.
So today, we're going to cut through that. We're doing a deep dive into what's really going on with U.S. mortgage rates. Our goal,
Hmm.
give you the context, the history, and yes, some actual steps you can take to navigate this market and hopefully snag the best rate possible.
Sounds good.
To do this, we've gathered some great sources. We've got data from Optimal Blue Water. They track mortgage data, analysis from Freddie Mac. We've also got historical charts from the St. Louis Fed, the FRAD data, which is super insightful, and some lender perspective from Blue Water Mortgage.
A really solid mix of data and context.
Yeah, should be good. Okay, let's unpack this, starting with, where do rates stand right this minute? Okay, so the absolute latest number we have, this is for a standard 30-year fixed-rate conforming loan. It's averaging 6.817%. That's from Optimal Blue, data as of June 17th, looked at on the 18th. It's up just barely, less than a basis point from the day before, but interestingly, down about 5 basis points compared to a week ago. So a little bit of movement there.
Any movements, yeah.
So that's the benchmark. How are the other loan types looking in comparison?
Yeah, it's interesting to see the spread. So like you said, the 30-year conventional is around 6.8%, actually down a little bit week over week and month over month. But then you look at, say, government-backed loans. The 30-year FHA, that's at 6.585%. The VA loan, 6.482%, so a bit lower.
Okay.
Though, interestingly, the FHA actually ticked up slightly over the last week and month. VA is kind of mixed. Jumbo loans for bigger amounts, they're a little higher, 6.948%, but they've seen a bit of a drop recently, which is nice for those borrowers. But the one that really catches my eye, and you mentioned benchmarks, the 15-year conventional, it's at 5.951%.
Oh, wow. Sub 6%.
Yeah, sub 6%,
Yeah.
down from over 6% just a week or month ago. That's a pretty noticeable difference if you can swing the higher payment.
Right. That sub 6% on the 15-year, that really does stand out.
Yeah.
But I guess, is it automatically the best deal? Or, what's the catch with that shorter term?
That's a really important question because, yeah, the lower rate on a 15-year is tempting. You save a ton on interest long term. But the trade-off, and it's a big one, is that your monthly payment is significantly higher, much higher.
Right, because you're paying it off faster.
Exactly. So for a lot of people, maybe most people, that higher payment just doesn't fit the budget, even with those long-term savings.
Okay.
So it really underscores that the best rate isn't just the lowest number, right? It's about what fits your financial situation, your cash flow.
That makes total sense. Okay, so looking at these numbers and thinking about that general feeling that rates are just stuck near 7%. What's the bigger picture here? What does this mean for market trends? What should we expect going forward?
Well, it definitely seems like the market, or maybe home buyers, had different hopes a little while back. A lot of folks thought rates would start coming down when the Fed signaled they might ease up on the federal funds rate last September.
Yeah, I remember that expectation.
But, well, that hope didn't really pan out, did it? There was like a tiny dip before the Fed meeting in September, but then rates shot right back up afterwards. And actually, by January this year, Freddie Mac data showed the average 30-year fixed went past 7% again. First time since, what, May of last year?
Wow, okay. So much for that dip.
Right. And it feels especially high when you compare it to, the crazy lows we saw back in January 2021. Remember, 2.65% on average.
Unbelievable rates. Feels like a different era.
It practically was. That was peak pandemic intervention, government pulling out all the stops to keep the economy afloat. Huge stimulus. And that leads to, a really key point here. The expert consensus is pretty strong on this. Barring some other massive global crisis, we are probably not going to see rates in that 2% or 3% range again. Maybe ever.
Not in our lifetimes, huh?
That seems to be the thinking, which, that really changes how you should think about mortgages long term, maybe less waiting for the perfect rate.
And more focusing on stability and what works now.
Exactly. Now, that doesn't mean rates won't come down at all. Rates around, say, 6%. That seems totally feasible if inflation stays under control and, lenders feel good about the economy.
Okay, so 6% is maybe a more realistic target zone?
Potentially. We even saw rates get close to 6.5% late February, and they dipped under 6.5% for a hot minute in early April before bouncing back up.
Right. So it's volatile.
Very. And there's still a lot of economic uncertainty. Some analysts worry the job market could tighten up again, maybe inflation reignites. It depends on policy choices too. All that could keep rates higher.
Which is why some buyers are looking at things like rate buydowns from builders, I guess,
Hmm.
to bridge that gap.
Precisely. Trying to find ways to make the current rates more manageable, especially for new builds.
Okay, that context is so important because, like you said, today's rates feel high, but history tells a different story. This is where it gets really fascinating.
It really does, because looking at that historical data, like the FARD charts from the St. Louis Fed,
Ugh.
it shows today's 7%-ish rates feel high only because we just experienced those rock bottom 2-3% rates.
The recent memory effect.
Totally. And again, those low rates were pretty much unprecedented, driven by massive government action during the pandemic. Under more normal economic conditions, the experts agree we're just not likely to see rates that low again. And historically, 7% isn't actually abnormal at all.
Really? What was normal then?
Well, think about the 70s, 80s, 90s. Rates around 7% were, well, pretty much the norm for a lot of that time. Sometimes higher, sometimes a bit lower. And then there was that massive spike in the early 80s. Get this. September, October, and November of 1981. Average mortgage rates were above 18%.
18%. Wow. Okay, that definitely puts 7% in perspective.
Doesn't it? And this historical view connects directly to something we're seeing now, this idea of golden handcuffs.
Ah, yes. Explain that.
It's homeowners who maybe want to move, need more space, different location, whatever, but they're sitting on these incredible 2.5% or 3% mortgages from the pandemic era.
The golden handcuffs.
Exactly. They're locked in, selling their home and buying another one at today's 6.5% or 7% rate. The math often just doesn't work, or it feels really painful, so they stay put.
Yeah, that makes perfect sense. I know people in exactly that situation. They feel trapped by their great rate, ironically.
Yeah.
Are lenders seeing that impact inventory?
Oh, absolutely. It's a major topic. It definitely contributes to lower housing inventory in many markets because fewer existing homes are coming up for sale. It's a really unique market dynamic right now.
Okay, so with that historical view and the current handcuff situation, let's get into the mechanics. What are the actual engines driving these rates day to day? Let's unpack the why.
Right. So what actually moves the needle on mortgage rates? There are a few big factors, and they're all kind of interconnected. Probably the biggest driver is just the overall health or perceived health of the U.S. economy.
How so?
Well, think about inflation. If lenders are worried that inflation is going to erode the value of the money they get paid back in the future, they'll charge higher interest rates now to protect their future earnings. Makes sense, right?
Yeah, okay. Hedging against inflation.
Exactly. And related to the broader economy, there's the national debt. This is maybe a bit more indirect, but when the government needs to borrow a lot of money, it issues bonds. That competes for investor dollars with other things, like mortgage-backed securities. More competition for money can push rates up.
Okay, so government borrowing can crowd things out a bit.
It can play a role. Then there's simple supply and demand for home loans themselves. If hardly anyone is applying for mortgages, lenders might need to cut rates to drum up business.
Makes sense.
But if demand is super high and lenders are busy, they might raise rates slightly just because they can, or to cover their operational costs.
Okay, and then the big one everyone talks about, the Fed.
Right, the Federal Reserve.
Yeah.
Their actions get a lot of headlines. And it's true, when the Fed hikes or cuts its main policy rate, the federal funds rate, mortgage rates often, move in the same general direction.
Often, but not always.
Not always, and not perfectly in sync. The Fed doesn't directly set mortgage rates. That's a common misconception. The Fed funds rate is an overnight rate between banks. Mortgages are long-term loans.
Okay, that's a crucial distinction.
Yeah. And there's another Fed action that might actually be more important for mortgage rates right now than the federal funds rate decision.
Really, go say?
It's what the Fed does with its balance sheet.
I have to admit, I always just focus on the federal funds rate announcements. Hearing the balance sheet might matter more for my mortgage rate.
Yeah.
That's definitely new to me. Why is that so impactful?
Yeah, it's less flashy, but super important. So think back to the pandemic or other downturns. The Fed can step in and buy assets to inject money into the system. One key thing they buy is mortgage-backed securities, or MBS. These are basically bundles of mortgages traded like bonds.
Okay.
When the Fed buys lots of MBS, it increases demand for them. Basic economics. Higher demand means higher prices for MBS, and higher prices mean lower yields or interest rates on them.
Oh, so Fed buying pushes mortgage rates down.
Directly, yes. But lately, the Fed's been doing the opposite. They've been trimming the balance sheet. They're letting the MBS and other assets they hold mature, and they aren't buying new ones to replace them.
So they're stepping back as a big buyer.
Exactly. Less demand from the Fed for MBS means their prices might fall and their yields, the interest rates tend to go up.
And that pushes mortgage rates higher for borrowers like me.
Precisely. So while everyone's glued to the Fed funds rate decision, the behind-the-scenes action with the balance sheet can have this really powerful direct impact on long-term rates like mortgages. It's definitely something to watch.
Wow. Okay, that's incredibly clear. Thank you. So we understand the history, the current situation, these big economic forces. What does this all mean for you, the listener? You're out there trying to get a mortgage now or thinking about it. What practical things can you actually do to get the best rate possible in this environment?
Right, let's bring it down to the individual level, because even with market conditions being what they are, you definitely still have some control. There are concrete actions you can take. First and foremost, get your credit score in the best possible shape. This is huge.
Why is it so critical?
Because a higher credit score signals less risk to the lender, so they offer you better rates. The difference between a good score and an excellent score can literally save you like 5 or even 6 figures in interest over the life of a 30-year loan. It's massive.
6 figures. Wow. Okay, what's considered excellent?
So generally, a conventional mortgage might require a minimum score around 620. FHA loans are more flexible, maybe down to 580 or even 500 if you have a 10% down payment. But according to Blue Water Mortgage, that lender perspective we mentioned, a score of 740 or higher is really considered top tier. That's where you unlock the absolute best rates.
740. Got it. What's next?
Second, keep your debt-to-income ratio, your DTI, as low as possible.
Okay, remind us what DTI is again.
Sure. It's all your monthly debt payments. Think mortgage, car loans, student loans, credit card minimums divided by your gross monthly income before taxes. Then multiply by 100 to get a percentage. So, quick example. If your gross income is, say, $5,000 a month, and your total debt payments are $1,500, your DTI is 30%.
Okay, and lower is better.
Yes. Lenders use it to see if you can comfortably handle another payment. Ideally, you want to be at 36% or lower for the best loan terms. You might get approved with a DTI up to 43%, sometimes even higher for certain loans, but lower is definitely better for getting a good rate.
Right. Pay down some debt before applying if you can.
Exactly. Okay, third thing, and this one's really key in any market, but especially now. Shop around. Get pre-qualified with multiple lenders.
Don't just go to your regular bank.
You can, but definitely compare their offer. Try and mix maybe a big national bank, a local credit union, and an online lender. Get rate quotes from maybe 3 to 5 different places.
Yeah, how do you compare them fairly?
Great question. Make sure you're comparing apples to apples. Look at the loan estimate documents carefully. Same loan type, same term. And pay attention to whether one quote includes points that's prepaid interest to lower the rate. It's an upfront cost, so you need to factor that in.
Okay. Does shopping around actually save much?
Oh, yeah. Freddie Mac did research on this. They found that borrowers who get quotes from multiple lenders, especially in higher rate markets like now, can save anywhere from $600 to $1,200 per year on their mortgage.
Wow, just from getting a few extra quotes. That's significant.
It really is. Takes a little extra effort up front, but the payoff can be huge over time.
Okay. Anything else?
Just one final point. Match the loan type to your profile. We talked about different loans having different rates. If your credit is fantastic, a conventional loan might offer the best rate. But if your score is maybe in the high 500s or low 600s, an FHA loan could be your best path to homeownership, even if the rate itself isn't the absolute lowest on the market. It's about finding the right fit.
That's super practical advice. Credit, DTI, shopping around, right loan type. Got it. So we've really covered a lot today. We went beyond just the headline rate, looked at the historical context, those 18% rates.
Wow.
Puts things in perspective. Definitely.
Yeah.
And we dug into the economic forces, the Fed's role, especially that balance sheet piece, which was eye-opening for me. And most importantly, we ended with those concrete steps you can take to hopefully improve your own situation when you're looking for a mortgage.
Yeah, hopefully moving from just feeling stuck to feeling a bit more empowered.
And maybe here's a final thought to chew on, based on our whole discussion. Considering everything we've talked about, the historical cycles, the Fed's less obvious influence, the golden handcuffs might really understanding these deeper forces change how you look at economic news or even plan your own long-term financial strategy, especially when it comes to huge decisions like buying a home. Maybe it shifts the focus a little bit, Less about trying to perfectly time the market and more about getting your own financial house in the best possible order first.
That's a great takeaway. Focus on what you can control. Excellent point to end on. Apply this knowledge, everyone, and here's to making smarter, more informed financial moves.